Venture capital is not just about making the first investment, it's about staying in the game long enough to capitalize on winners. The most successful funds do not simply spread capital across as many startups as possible. They strategically reserve capital for follow-on investments, ensuring they can double down on breakout companies and maintain ownership in their highest performing bets. Follow-on investing is a critical part of portfolio construction and long-term value creation. Without a disciplined approach to reserving capital, a fund risks being diluted out of its best deals, missing out on later-stage value growth, and ultimately underperforming in terms of returns. The right strategy involves balancing initial investments, follow-on allocations, and managing reserves effectively, ensuring that the fund remains competitive across multiple rounds of financing. A VC fund's first check into a company is just the beginning of the investment journey. Most startups go through multiple funding rounds, from seed to Series A, B, C, and beyond, increasing in valuation and raising more capital to scale. Follow-on investments play a crucial role in maximizing returns on winners. Early-stage investments carry the highest risk, but by reinvesting in later rounds, funds can maintain ownership in the most promising companies. They also help avoid dilution. If a fund does not participate in follow-on rounds, its ownership stake decreases as new investors come in, reducing potential upside when an exit occurs. Additionally, supporting portfolio companies through follow-on capital strengthens their position, making it easier for them to attract new investors and secure future funding rounds. For example, if a fund invests $2 million in a startup at a $10 million valuation, owning 20%, but does not follow on, its stake can be significantly diluted when the company raises a $100 million series be led by another firm. If the startup later exits at $1 billion, the difference between participating in follow-ons and not could be the difference between a $20 million return and a $100 million plus return. A well-planned follow-on strategy ensures that funds maintain their positions in their best-performing companies, securing long-term value and maximizing overall portfolio returns. Reserving capital for follow-on investments is a key part of a deliberate portfolio strategy, not something left to chance. Most well-structured VC funds allocate between 50 to 60% of their total capital for follow-ons. Precisely, a typical fund might allocate around 30 to 40% for initial investments, which are the first checks into new startups, while 50 to 60% is set aside for follow-ons to double down on top-performing companies. The remaining 10% is kept for unexpected opportunities or strategic bets. For example, in a $100 million fund, only $30 million to $40 million might go into initial investments, while over $50 million is reserved to support the strongest portfolio companies as they grow. The logic behind this is straightforward. Many early-stage startups fail or stagnate, and only a select few will become major successes. By having a follow-on strategy, the fund ensures it retains significant ownership in those breakout companies that ultimately drive strong returns for the entire portfolio. Not every portfolio company deserves additional capital. The key is identifying which startups are truly scaling and merit increased investment. Follow-on decisions typically hinge on milestones achieved, such as product market fit, revenue growth, or strong customer retention. Market validation is another crucial factor. If external investors are eager to lead the next round, it signals confidence in the startup's trajectory. Funds also consider ownership stakes to ensure that follow-on investments maintain meaningful equity positions. Ultimately, the decision balances risk versus reward, determining if the startup has the potential to deliver outsized returns compared to other opportunities. Some VCs take a pro-rata plus investing approach, automatically exercising their rights in every round for companies that meet specific performance benchmarks. Others are more selective, doubling down on only the best-performing startups. A strong follow-on strategy ensures capital is not wasted on struggling companies and instead is directed toward the few startups with a real chance of delivering 10x plus returns. While follow-on investments are essential, mismanaging capital reserves can weaken fund performance. A common mistake is overinvesting in weak companies, where investors emotionally back struggling startups instead of cutting losses. On the flip side, under-allocating reserves can lead to dilution in high-growth winners, limiting potential upside. Another risk is blindly following pro rata rights, investing automatically in every round rather than selectively doubling down on true winners. Funds that fail to reserve enough capital may find themselves unable to participate in later rounds, leading to dilution and lower fund returns. For instance, if a fund invests aggressively early but leaves only 20% for follow-ons, it may struggle to maintain ownership in breakout companies once external investors drive valuations higher. Conversely, holding back too much capital without deploying it into strong opportunities can lead to missed returns. Effective follow-on strategies require active portfolio management and constant reassessment of capital allocation to maximize success. Take the case of Benchmark's investment in Uber. Initially, Benchmark invested $12 million in Uber's early round, securing a meaningful ownership stake. Over multiple funding rounds, the firm continued investing in Uber's growth, maintaining its position even as valuations skyrocketed. By consistently reserving capital for follow-ons and defending its ownership, Benchmark turned that initial investment into billions of dollars in returns when Uber went public. In contrast, many early investors who did not follow on saw their stakes diluted significantly, missing out on Uber's later-stage value creation. This example illustrates why having capital available for follow-ons is just as important as picking the right startups in the first place. A strong follow-on strategy can create a powerful flywheel effect that benefits a venture capital firm across multiple fund cycles. By retaining ownership in successful startups, a fund is positioned to generate larger returns when those companies eventually reach an exit. Maintaining a meaningful stake in high-performing portfolio companies ensures that the fund captures more of the upside as these businesses grow and mature. These strong returns then enhance the overall performance of the fund. As a result, the firm becomes more attractive to limited partners who are looking to invest in future funds. A proven track record makes it easier to raise new capital and to do so with greater confidence from investors. With more capital available in future funds, the firm is better equipped to compete for highly sought-after deals. This increases its ability to back the most promising startups, further strengthening its reputation and influence within the venture capital ecosystem. This is why top-tier venture firms structure their funds with follow-ons as a central priority. The best-performing funds are not necessarily those that invest in the most companies, but those that concentrate capital into their strongest winners and hold ownership as those companies scale. For emerging fund managers, understanding this dynamic early is crucial. Instead of just focusing on getting into great deals, the real challenge is staying in the best deals long enough to capture their full value. A well-executed follow-on strategy ensures that a venture fund does not just participate in the next generation of billion-dollar companies, it owns a meaningful share of them when the real value is created. Because in venture capital, success isn't just about finding winners, it's about staying with them all the way to the finish line. A well-structured follow-on strategy is critical to venture fund performance, allowing investors to capitalize on their best startups while avoiding dilution. Leading funds reserve a significant portion of their capital for later-stage reinvestments, selectively backing only the strongest companies that show clear traction. Mismanaging follow-on allocations, either by overinvesting in weak startups or failing to maintain ownership in winners, can significantly impact fund returns. The best VCs don't just find great startups, they ensure they have enough capital to stay in the game and fully realize their winners' long-term value.